What do you do with your money when you get paid if you were self-employed? I'm going to walk you through exactly what to do to take out the mystery and confusion. But first off, before you take in any money at all in your business or your self-employment, make sure that you are set up with the following accounts. Number one, a personal checking account. Number two, a business checking account. Number three, a business savings account, and a self-employed retirement account, such as a SEP IRA or a solo 401k. You will also need a bookkeeping method, such as QuickBooks, Xero, Mazuma, or hiring a CPA. And lastly, always consult with a tax professional or a financial planner. Do not trust anyone's advice on the internet, including mine. Number one, set aside money for taxes. You should always consult with a professional on exactly how much you should be setting aside for your unique situation, because this amount is going to vary according to many different circumstances that are unique to you and your business. But a generalized rule of thumb is to set aside 30% of your earnings for income taxes. You will be obligated to pay self-employment tax, which across the United States amounts for 15.3%, federal income tax, and state income tax. These three taxes are going to be calculated based on your net income, which means your profit after your expenses and deductions have been removed. However, setting aside 30% of your total sales is a good way to ensure that you don't accidentally underestimate. Next, determine if you're obligated to pay sales tax. This should be determined prior to making the sale so that you can collect that sales tax along with the transaction from your customer. But either way, even if you did not collect this, you still are going to be obligated to pay sales tax if you are selling tangible products or labor that later on down the line will result in the sale of a tangible product to that same customer. You will both need to hold a seller's permit as well as remit that sales tax to your state sales tax board unless you are using a marketplace facilitator in order to conduct your sales who collects and remits that sales tax for you. Sales tax laws differ from state to state, so it's very important that you read up and understand the sales tax laws for your specific states in which your business operates, as well as where your customers are purchasing from. Next, set all tax money aside immediately into a completely separate savings account until tax time. Number two, determine how much you will be paying yourself. Transfer this amount from your business checking account to your personal bank account. This can be done at any frequency, at any time, and in any amount. This is called doing an owner's draw or an owner's distribution. Number three, determine how much you will be contributing to a self-employed retirement account. Money invested in a SEP IRA or a solo 401k is tax-free, meaning that you can save for your retirement and lower your taxable income. There is a maximum contribution to your self-employed retirement funds of up to $69,000 for 2024. And lastly, number four, ensure you keep your bookkeeping updated and generate a profit and loss report monthly, which shows exactly where your money is going, what your expenses are, and what is the most profitable in your business in order to help you make the best financial decisions and plans for business growth. Profit and loss reports can be automatically generated using your bookkeeping software on most platforms.